All right, welcome to the training. I'm going to be going over the difference between a Target Premium IUL and a Max Funded IUL, showing the intricacies for it, as well as the overview of the numbers. So first, I'm going to show a Target Premium policy. This actually was one of the insurance companies that my brokerage works with and partners with, National Life Group. They've been around for over 100 years. They actually paid out the death benefits to the families of the people that died on the Titanic. Very reliable company. They also have a great IUL product that's high growth and excellent loan. Let's get into the growth a little bit and what growth do you typically expect with IUL in general with National Life Group. It's going to be critical when we're looking at the numbers because obviously we want the most money getting allocated to the most growth. So the first thing I want to highlight is the coverage that is given with this particular policy. This policy, the $500 a month policy, $6,000 a year plan premium. In other words, the money that's being paid into the policy. So you got $6,000 being paid into annually, and the coverage right away is $709,000. Remember this because this is critical. And these are also some of the living benefits associated with it. Life insurance is not just insurance when you're dead, it's insurance while you're alive as well. And these aspects right here will help cover you while you're alive and supplement your health insurance. So terminal illness, chronic illness, critical illness, critical injury, and even Alzheimer's. And some of them have long-term care riders as well. So let's drop down and look at the growth because the growth is very important in this case. You want to see what the policies will get to make sure that you get that growth. It's still guaranteed that you won't go below 0% due to the market dropping. So here we have a historical chart of what's actually happened in the past. So first things first, the IULs have been around since the 1990s. So people have gotten this complete growth. US Pacesetter Index is pretty much the main one that I help investors and people getting IUL through National Life Group set up because of the growth and high participation rate. And there's no cap on the particular index. So I'm gonna highlight just a couple of years. So let's look at 2010. 2010, the regular US Pacesetter Index did 14%, but anyone with IUL did 31.6%. Let's look at a down year, which is pretty much the worst case scenario. Well, just last year, this particular index dropped 15%. Yes, it dropped 15% for people that don't have IUL following that index. But if people have IUL following that index, they lost nothing. They lost 0% and they locked in their gains. And this is pretty good for people to have IUL because those years that you lock in your gains, you're prepping yourself for more exponential growth. So let's look at here. The market was negative initially. It was 0% floor, but right afterwards, people got substantial growth. So we look at basically 10%, 32%. 30%, 16%. So more than 50% growth on your money when you've already locked in your gains and you haven't experienced any losses. Now, looking at the averages over here, we look at the 15% average for the last 20 years, US Pacesetter, 13%, 11%, and 13% for the last 5 years. But all the numbers I'm going to be showing you have a max of 6.42%. I can't show any higher than that. That's where it is. And the interest bonuses is going to be 0.45%. So here we're going to take a look at some of the numbers, and most people that talk about IULs that hate IULs hate this particular structure. It's not really IUL as a product that's a problem. It's more so the agent that sets it up. So a lot of these agents are unaware of the right way to do it, or they're selfish and want to get the commission. They have different reasons, but the truth of the matter is Dave Ramsey and people like him do not like IULs because they're structured purely this way. So let's look at it more in detail. In this particular example, the client is 31 years old. So he's 31 years old, paying $6,000 a year. We don't really acknowledge this column right here just because this isn't the usual case. This is more of a whole life scenario when it's 3% every year for the life of the policy. That's not going to be the case at all. So we ignore this as pretty much like worst case scenario in terms of getting growth. The column that we focus on is going to be over here, the current illustrated values. So like I mentioned before, the max that I can show in terms of the numbers is 6.42% annually every year, but this is not whole life. It does follow the market. So it's not going to be 6.42%. The 20-year average for US Pacesetter is 15%. You could be seeing substantially more growth than this. So these numbers are still pretty conservative realistically. Now, he's paying $6,000 a year. The accumulated value is the amount that he's getting interest on. So he's getting interest on $4,132. And the cash surrender value is the amount that he has access to take out as a loan. Think of it similar to a credit limit. He has access to $0 the first year and $0 the second year. The third year, he's putting $18,000, 6,000 times 3, and he only has access to $2,200. That's not a lot of money he has access to in his waiting a long period of time. If someone just cares about insurance, then this is ideal for them because they get a lot of insurance set up. But At the same time, if you're looking for infinite banking and getting that implemented, this is not ideal for you because why do you care about having a whole bunch of insurance? You just grab a term policy or whatever to cover that for you. You care about maximizing your cash value growth in this case. So the net death benefit is basically the amount that's paid into the policy plus the interest plus the initial coverage that he paid for. So after year one of paying $6,000 into the policy, his net death benefit is going to be $708,000. This isn't really relevant for him because he's using it for infinite banking. You can access up to about 90% of that amount at any given time if you qualify for it with the chronic illness, critical illness, and whatever. Chronic illness and critical illness and so on. But once again, this is not ideal for infinite banking. Now, I also set it up where his payments are limited to 10 years. You do not want to be required to pay for the life of yourself. It doesn't make any sense when you can actually pay for a lot less time. So in this case, we set it for 10 years. He's going to be paying $60,000 into the policy. Let's see if this is actually self-sustainable and the policy does not lapse. So looking here, all I did was scroll down. The policy does not lapse so far. When he's 80 years old, it's not lapsing. But one key thing to notice is that the amount is changing. The amount is changing in a bad way. Once he's 71 years old, he starts losing money in the policy, his value in money in the policy. So it's going to keep dropping, keep dropping, keep dropping because the cost of insurance is so high at this point after you're 65 that it does not sustain itself. And keep in mind, this is still 6.42%. So it might be a couple years afterwards in terms of real life conditions, but the truth of the matter is it's not lasting anyway. So by the time he's 80 years old, he already lost $100,000 of the money he has in the policy. So let's keep scrolling and see what age it actually expires. So by the age of 83 years old, the policy is fully expired, meaning the policy will completely lapse and he will lose every single dime he has in his policy. So all that money is gone. He lost money completely. He just kept dropping and it completely expired. You do not want this to happen. You always want the policy to last your whole life, or I would say expire when you're past your 100 years old. It doesn't make any sense for you to get this up any other way besides that you're just hurting yourself. So all the days that are watching this that have some knowledge about actually doing illustrations, yes, I could have made him pay longer than 10 years, more than 60,000 into the policy, but that's not the goal. The goal is to give him the minimum amount of years to pay into his policy. He can keep paying as long as he wants, but I want to give him as short amount of time to pay in the policy as possible. So let's take a look at the max funded IUL. A lot of people do not talk about this, and very few people actually show you what I'm showing today, the actual numbers and breakdowns of it. It's going to be the same $500 a month plan. The coverage is substantially more different. Same amount being paid into it, but he has 161,000 in coverage. Yes, he's underinsured in most cases, but tenants policies for infinite banking being able to leverage his dollar, the same dollar twice tax free. We have another way to give him that coverage at a very, very, very low price. And I'm not going to go over that in this video, but you can talk to me on the side and we can have a discussion about that. So the living benefits still has access to living benefits. The amounts dropped a little bit just because the coverage isn't as high, but he still has that ability to have some insurance while he's still alive to benefit him in case he gets sick or a heart attack or COVID-19, whatever the case may be. Now, looking at the U.S. Paysetter Index, the growth is going to be exactly the same as with the Target Premium policy. The only thing that's going to change is the amount of money going into it and the cost of insurance and the coverage. Once again, he's 31 years old. He's paying $500 a month into the policy, which is $6,000 a year. And we're going to ignore this alternative current illustrated values column. That's at 3% growth every year. It's not realistic at all. Most whole life policies aren't even 3%. So ignore that. And we'll move on to the current illustrated values, which again is still under promising, which is still underperforming considering what the actual growth is, that index, which is 15% average over the last 20 years. So this is 6.42%, can't show any higher. And this is the current illustrated values column. Quick recap, the accumulated value is the amount that he's getting interest, the amount he's getting interest on at any period of time. So for the first year after paying that full $6,000, he's going to be getting interest on $5,453. So his cost of insurance essentially is less than $600 compared to the Target Premium policy. Now let's talk about the money he has access to take out as a loan. Cash surrender value is the money he has access to take out as a loan in this particular structure. There are ways to increase this, but in this case, this is fine with him because he's getting more money than a Target Premium policy to begin with. Target Premium policy had access to $0 in the first year. With this, he has access to 47% of the money he put into a policy in the first year without any additional modifications. Now, the second year, he's paid $12,000 into the policy. He's getting an interest on $11,222, which is about 90% or so. The accumulated value is basically the amount you pay into the policy minus the cost of insurance. And then the second year, He's paid $12,000 in policy. He has access to take out as a loan $8,704. This is 71% of the money he's paid into the policy has access to year two. This is only going to increase as we keep going on and on and on. National Life has a 10-year surrender period, so the amount you have access to typically doesn't match up with the amount that you're getting interest on until year 11. So year 11, he's 41 years old, and he has access to the full amount in there, which is $77,000. This is going to keep growing and growing and growing and growing. I set it up to where the money he's gaining and the money he's putting into policy is going to be received by his family once he passes away, which is the net death benefit. That's going to keep increasing every single year as well. Now, in terms of infinite banking concept, I'll give a quick synopsis about that. So their money, so think of the cash surrender value here as your credit limit. This is the amount that you can take out at any given time. Let's say he wants to take out $2,000 to do whatever with. The cash surrender value essentially isn't an account, it's just a threshold. The net death benefit is actually an account. Essentially, the amount that he takes out on a loan will be deducted from his credit limit in terms of the value. So he'll have $802 left that he can take out as a loan, but it really comes out of the net death benefit since you're using the money that you have as collateral. So whenever you pass away, if he doesn't pay that money back, he's going to have 158,000 instead of 160,000 right here. Now let's clear that. Even if he takes out that $2,000 as a loan, he's still going to be getting interest on the money as if it never left the account. The accumulated value will never go down, no matter how much money he takes out as a loan. This is where you're using the same dollar twice and tax-free, because any money you take out as a loan is tax-free. It's going to keep increasing every year, even if you took out $2,000. That is the concept of infinite banking. You're still going to have the money working for you. You're still going to have the money working for you, even though you have the money working yourself. Now, another thing to highlight is $60,000. That's still what I have him paying into the policy. That has not changed between the target premium policy and the max funded policy. Now, let's see how long this policy actually lasts now since it's max funded. So I'm just going to scroll down and see how long it lasts. At this point, 70 years old. Still lasting, still lasting, still lasting. Looking at the right column. Still lasting until he's 120 years old. It's going to go past this if he lives past that, but I don't think he wants to live past 120 years old. Now for this, he still only paid $60,000 of the policy through his first 10 years of owning the policy. But let's say he lives to 120 years old. He now has owned this policy for 90 years. He's 120 years old, paid $60,000 into this policy. That's it. And he has access to withdraw $5.7 million completely tax-free. If he keeps living, he's going to be getting interest on $5.7 million. As you see here in the earlier years, it just kept increasing, 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 increasing. This is a very big benefit of max funded policies because you're maximizing your growth of your money, and it's following indexes such as the US pay study. You're getting an average 15% growth every year with no losses. This is a true power of IUL. This is personally why I think a whole life does not compete with IUL, because of growth. If you're thinking about using infinite banking, why would you use a policy where you have guaranteed 4 or 5% when you can have a policy getting 15, 20, 30% and not experience any losses due to market downturn? People have their own reasons. Every client is not the same. Every policy is not built the same. But in terms of infinite banking, I believe that max funded policies are the most beneficial to pursue. And the main reason is because of the growth and some added other reasons, such as the flexibility of payments. You got flexibility going down, pay less than your scheduled payment. So in this case, he's scheduled to pay $6,000 a year. You can actually pay less, or you can pay more than that amount before getting taxed. But to sum it up, this is a comparison between the Target Premium IUL and a max funded IUL, and why people don't like the Target Premium and why people love max funded. Everyone I show at max funded IULs to has been completely blown away by it. And the reason being, they don't know about it and no one tells people about it. And in order to do max funded policies, I actually had to shrink my commission by 80, 90%. So I'm really acting in the best interest of the client whenever I get these policies set up. My goal is to have clients completely satisfied with their policy that will last the rest of their life. They'll have great growth in their money. They'll be set up with good policy loan options. And on top of that, they're going to have flexibility in their payments. That is a goal with every client that I work with. And if you want to get a consultation to see how this could work for you, go ahead and DM me. I can answer any question that you have. We can set up a call. I'll send you my Calendly link and we'll go from there. Or just drop a comment under this video. I hope you got a lot of value from this. This is not information that's readily available online. So definitely take advantage And even if you don't go with me as your infinite banking specialist or life insurance agent, definitely apply this knowledge to any other quote that you receive from any other agent. You'll be pretty set.